Imagine owning a tiny slice of the Eiffel Tower, or maybe just a single brushstroke of the Mona Lisa. I mean, that's the incredible promise of tokenization, right? A technology that could totally democratize ownership of, well, everything. But here's the big question. Is it a financial revolution that's about to change our world, or is it a time bomb just waiting to go off? That's what we're going to dig into.
Yeah, everyone's talking about it. Slice a skyscraper into 10,000 little pieces. Sell them off as tokens to everyday investors. It sounds like financial magic, doesn't it? But here's the brutal truth. Behind all that hype, tokenization can just as easily take old risks and make them bigger, and you guessed it, create brand new ones. So let's separate the hype from the reality.
To really understand the potential here, we've got to start with the basics. So let's get down to the fundamentals. What exactly is tokenization, and what problems is it even trying to solve in the first place?
At its heart, tokenization is all about turning physical things into digital things. Just picture it. You take a building, a bond, maybe even a piece of art, and you create a digital certificate of ownership for it. And that certificate can be traded super easily on a blockchain. It's kind of like we're upgrading the financial world's old rusty pipes with a brand new high-tech plumbing system. But, just like with any plumbing job, you've got to make sure the pipes are secure and the water is clean. And the process itself is surprisingly straightforward. It's really just 3 steps. First, you pick an asset in the real world. Then you create that digital token that basically says, hey, I represent ownership of that thing. And finally, you can trade that token on a blockchain, just like you would a stock or a bond. This is what could open the door to 24/7 markets and a whole new world of investment opportunities.
So now that we've got the what, let's get to the why. Why is everyone from Wall Street to Silicon Valley so incredibly excited about this? What's the powerful potential that's got everyone buzzing?
Well, the potential benefits are huge for sure. You're looking at 4 big promises. First, there's fractionalization, which lets us chop up expensive assets like real estate into smaller, more affordable pieces. Then you've got faster settlement, which means less risk and way more efficiency. Third is programmability. This lets us automate all sorts of complex stuff like compliance checks or paying out dividends. And finally, you get these new liquidity pools that could unlock the value of things that have always been tough to sell, like art or private equity.
To really appreciate why faster settlement is such a game changer, think about this. In the traditional financial world, it can take up to 2 days for a trade to be finalized. They call it T+2. It's kind of like sending a letter and waiting for it to arrive. With tokenization, a settlement can happen in a matter of seconds. It's literally the difference between snail mail and email.
But okay, before we get too carried away, we have to talk about the dark side of tokenization. Because for all its promise, there are some really serious, brutal problems that we just can't afford to ignore.
The biggest myth about tokenization is that it just automatically creates liquidity. The truth is, you can't just create a market out of thin air. If you don't have actual buyers and sellers wanting to trade the thing, you're left with a digital ghost town, an illiquid digital tombstone.
And this is where things get really tricky. Your token might say you own a piece of a skyscraper, but what happens if the company that issued the token goes bankrupt? Do you still own your piece of the building, or are you just left holding a worthless digital IOU? That's the billion-dollar question that regulators, like the International Organization of Securities Commissions, or IOSCO, are still trying to figure out.
And that brings us right to the custody problem. If the company that's holding the actual physical asset goes under, your tokens could become totally worthless. It's a classic case of not your keys, not your crypto, but for real-world assets. That shiny new token doesn't magically remove this very old-school risk.
And finally, there's the fragmentation problem. Even the International Monetary Fund, the IMF, is warning about this. If every company just goes and creates its own private blockchain, we could end up with this messy patchwork of isolated markets. It'd be like having a bunch of different internets that can't talk to each other, which completely defeats the whole purpose of creating one big, efficient market in the first place.
So how do we solve these problems and actually unlock the true potential of tokenization? Well, that's where the regulators come in. They're working right now to create a framework, some guardrails that can protect investors and make sure it's a level playing field for everyone.
For a long time, regulators were mostly on the sidelines, just watching this whole tokenization experiment unfold. But now, they're stepping onto the field and actually writing the rulebook. Global bodies are pushing for a same activity, same risk, same regulation approach. The idea is to create a global standard for tokenization that protects investors but also fosters real innovation.
So what's the bottom line here?
Is tokenization the future of finance? Or is it just another bubble that's waiting to burst? To help you make up your own mind, we've put together a practical checklist that'll help you separate the real signal from all the noise.
Before you even think about buying a tokenized asset, ask yourself these 5 questions. First, do I really, legally own the underlying asset? Second, who is holding that asset, and can I actually trust them? Third, are the fees and rules completely transparent? Fourth, is there a real market for this token? And fifth, is this a regulated product? If you can't get a clear yes to all of these, you might want to think twice.
You know, the future of tokenization isn't about hype or flashy marketing. It's about building a solid foundation of trust, transparency, and legal certainty. The companies that are going to succeed are the ones that prioritize these values over any short-term gains.
So, we've come full circle. Knowing what you know now, the good, the bad, and the ugly, would you be willing to bet on the future of tokenization and buy a piece of a digital skyscraper? The answer to that question could really determine the future of finance as we know it.